The coming drop of Brown-Forman, or the company that owns Jack Daniels. Let's take a look at this stock, and I will show you why I believe this stock will drop 15% or lose about $10 a share here in the coming periods because it has over-leveraged itself by ballooning debt $2 billion over the last decade, but never actually growing earnings to boot. Ready? Let's get to work. Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. We're going to take a deep dive today into Brown-Forman Company, the company that owns and manufactures Jack Daniels, along with a whole host of other alcohol companies, Woodford Reserve, Old Forester, Jack Daniels, which we covered, El Jimador, Finlandia, Ford's Gin, Glendronach, and Ben Riach, one of my favorite scotches. And there's lots of distilleries that they own. And the stock is traded for a premium for a long, long time. And I think they've abused that privilege because they are family owned and controlled. So you have very little voting control for the public shares. But let's dive into the stock and let's figure out what's driving the underlying economics, how much cash money they make, and why the stock will fall here in the coming years. Okay, let's go through the cash flow club. Now I'm showing you the cash flow club at cashflowinvestingpro.com. We have a number of analysts covering about 200 stocks, and we only look for pure cash flow money stocks, and we try to dig deep and find the companies that are going to return big money for you as a member. This stock is not going to be one of them, but I think it's a great lesson in what's going on right now in the capital markets and why higher interest rates are really going to hurt earnings going forward. Now I'm going to scroll through to show you quickly some of the data that we do put in there. We're grabbing financials, we're throwing in there, as well as our own fundamental analysis on the stock and the pure cash flow that it makes. And one thing I do want to show you is just the performance of this stock over the last 40 years, has been absolutely tremendous as they've been able to grow by acquiring brands. And that works. If you're trading at a high market multiple like 20 times, and you're buying brands at 5 or 8, 10 times, you automatically get the market multiple expansion. That's the private equity model. These guys have done a phenomenal job over the last many, many years doing this. I think right now, given where we have been with the cheap debt, I will show you why the stock is due to fall. Okay, here we go. Here's a classic example of a company that has over-leveraged themselves and failed to grow earnings as a result of that borrowing capacity. So this X line here is net debt to EBITDA. So that's total debt that they have divided by the EBITDA, earnings before interest, tax, depreciation that they generate. And they were trading earlier in the decade when they had about $1 billion of earnings of EBITDA and $1 billion of debt. That's 1 times. Today, debt has doubled, so more than doubled, 2.3 times. So debt is 2.3 times higher than earnings. So earnings are roughly the same. Okay, $1 billion to maybe $1.2 billion. Okay, a 20% move, fine. Over a decade, that's not much. But debt has more than doubled, going from $1 billion to just shy of $3 billion over that period of time. And they have not been able to grow earnings with that money. So where did that money go? What are they doing? And more importantly, to buy down that debt, they're going to take free cash flow in the future periods to buy that debt down. Now that interest rates have gone up, that means equity holders have less free cash flow and the stock is going to come down. Let's take a dive into the one-pager. Before we dive into the one-pager, let's review the 5 key attributes that we use in this channel to begin the fundamental analysis of a stock. Number 1, revenue growth. You want to see a company that's growing top-line revenue. Number 2, earnings growth. We use EBITDA. That should be growing. Number 3, strong free cash flow. Number 4, low debt. Number 5, a well-priced stock. A well-priced stock simply means a stock with a very conservative forecast. You believe it's going to beat the stock market. That's it. That's our definition. That allows you to begin your due diligence to do further fundamental work on the macroeconomic factors, management backgrounds and bios, dig into the accounting, the assets, liability. All that stuff comes after you've checked all 5 boxes as a starting point. But we summarize that for you here on these one pages. You can find them at my website, cashflowinvestingpro.com. This is not financial advice. Do your own due diligence. Cashflowinvestingpro.com right there. Got the one-pager for Brown-Forman, the people who own Jack Daniels. So here we go. Let's dive into these numbers. I'll show you why I think this stock is going to go down. All right, let's dive into the revenue for this company. So 2014, they had just shy of $3 billion of revenue. And that has grown weekly, but still positive, over the decade. Last year, they booked $4.2 billion of revenue. That's an average growth rate over that 10-year period of time of 4%. Earnings have been at $1 billion in 2014, have grown to $1.3 billion, with most of this growth coming in the last 2 years. Prior to that, they were flat for 8 years. Then they had a little COVID spike, and they've been able to maintain that. That might honestly just be price increase with lower priced inventory, because Scotch and it has to be aged a long time. That could be sitting at a lower cost. So when you sell it, you have a higher margin. So that could be temporary if it stabilizes. Anyways, they grew earnings at 3%, revenue at 4%. That checks the box, but it's weak single-digit growth. If we look at debt went from $1 billion to $3 billion. That's a 13% annual growth rate in debt, which I covered very, very earlier on, and that's very, very fast. Market cap has grown at 5% annually, $19 billion to $30 billion. Enterprise value is roughly the same, $20 billion to $33 billion over this period of time. But what I want to show you here is the actual value metrics here. What's driving this? Our debt to EBITDA ratio went from 1 time, which is a conservatively forecast business, to 2.3 times, which is more than doubling the debt level in this period of time with no actual earnings growth. The enterprise value to EBITDA went from 20 times to 25, almost as high as 30 times. So this company trades at a premium for a company that doesn't grow. Why? Because they're buying back shares. And I'll show you this. I'll zip to it here in the cash flow section. They're buying about 1% of their stock back every single year, and they're using the debt that they borrowed to go do that. And they're not using the debt to grow underlying earnings, which is a problem, because if you can't borrow anymore, or the cost of debt becomes too expensive, you can't buy these shares anymore, and the earnings growth, per share earnings growth, that the market loves to value stocks on is going to fall. And when that does, the market multiple, the premium that people are paying because they think the growth per share is real, is going to fall. And this stock is going to go from 25 times to about 18 or so times. And when I do that, if I look at next year's earnings, of $1.4 billion, and I apply a 18 times market multiple to that, I get $48 a share. And $48 a share is a lot less than it's currently trading for. It's currently trading at 57 bucks. So that's a drop of about 15%, and I would wait for that collapse in price before you buy it. If you got it at 18 times, I think then it's a much more realistic price to pay for a company that honestly is going to take a couple years to pay down the debt. That debt grew for about $2 billion, but let's see how much free cash flow they actually make. Free cash flow from operations. So we take a look at free cash flow from operations. You got last couple years, it's basically been $900 million of free cash flow, with a drop to $600 million this last year. Puts it at basically zero. This is probably some inventory reinvestment. That's probably why it was down so much. But you've got a number, let's call it $800 million. Here, you've got about $100 million of CapEx. So that leaves you about $600 to $700 million of free cash flow before debt service. But you have to pay down about $2 billion of debt that they borrowed that they're going to have to pay down. That's going to take them 3 to 4 years of using this free cash flow to buy that debt down. Now, this is what I would do, not necessarily what they would do. But that, to me, is a hindrance on the free cash flow of the business, and I would put some caution out there about buying the stock today. But nevertheless, we put a forecast out there that we think the stock could be worth $71 a share on some conservative numbers. I've got a cash flow, per share value of cash flow here that does not include the pay down of debt. And I get an average return of 5%. So this return here is bond-like. You can buy a risk-free treasury bond for almost 4.5% right now. This equity return is 5%, and this equity return stands behind a bunch of debt that's in front of it. So it's definitely something that I would hold off on. I don't think that the risk-return profile is right here. if the stock did fall, it's got to fall, like 40, 42 bucks to start getting anywhere near a real IRR that's going to expected to beat the market. So I would watch for this stock to fall. I think it should fall if the market's pricing things appropriately. And when it does, then it's a time to take a look at this one. Let's review the 5 key factors here. Number 1, top line revenue growth. It's good, it's growing. Number 2, earnings growth is growing fine. Number 3, strong free cash flow. No, I don't think it's strong free cash flow. I think they have to buy down the debt. Number 4, low debt. Technically, debt is less than 3 times, so we'll check the box. And number 5, well priced. No, it is not well priced. It has too much debt. The growth is too weak, and it's going to underperform in my estimates and in David's, the analyst, expectations over the next 10 years. So I think your capital is better invested elsewhere. Put this one aside, wait for it. If the stock collapses because people freak out of their ability to buy back the debt down, then it's time to step in, but right now I'd hold off. If you like this kind of work, check out my website, cashflowinvestingpro.com. You can sign up for the email list and I'll give you a free one-pager so you can check that out. If you join the Cash Flow Club, our analysts cover about 200 different stocks where we hunt down for the pure cash money that they are producing to try to give you an idea of what you should be buying out there, where you can have a fundamental understanding of what the stock does. You can see what the forecast is. Forecast might not be true. Nobody knows what the future is. But if you have a grounding of how we came up with the numbers, perhaps it's a better way that you're going to hold that stock for the 10, 20, 30 years you need to be holding an equity investment, because you are a partner in a company. You are not simply buying some ticker on the screen. No. You are a partner, and you should act like a partner when you buy stock. So definitely check that out. I would also encourage you to take my course where I teach you how to be an analyst. I'm a CFO by trade. That's what I do for my primary gig. This is a hobby of mine. And I wrote a course back in the pandemic where I teach people how to fundamentally analyze stocks. It's a quick kind of crash finance course, but it will give you a wonderful background, or foundation on how to look at stocks, how to calculate revenue, earnings, how to calculate debt. You don't take the entire debt line. You are pulling specific line items on the debt to calculate debt. What these ratios mean, what is a free cash flow yield versus a market multiple, how to make a forecast, to try and give you the understanding to build a focused portfolio that will work for you and compound your money over the next decade or more. So check out cashflowinvestingpro.com. My name is Cameron Stewart, CFA. Thank you very much for watching Rational Investing. This has been a review of Brown Frohman, and I will let me know what stocks you want to see down below. Throw a comment down below, hit the like button. Don't forget to subscribe. I greatly appreciate it. Take care. Bye-bye.